Hello everybody, the chart on your screen is that of a 3-year investment on an index fund. An index following many other different charts, sort of like a Dow Industrial Average. This is in a bull run, a bull market. In fact, there is hardly any retracement whatsoever. You'll say stocks don't go up like this. They can't go straight up now, can they? Well, this isn't a stock, though. However, this can be your investment. And when you look at this, you see a gain from 1,000 to over 1,800. That's about 80% in about 3 years. And you're not going to get a bond that will give you 80% on 3 years. And if you try to go stocks, maybe you might get 80%, but what you will have is major volatility, even when it's diversified. You've heard Jim Cramer on Mad Money say you need to diversify your portfolio. Yes, it's okay to have a gold stock, but mix that up with a financial stock, a consumer discretionary stock, an industrial stock, and a utility stock. Go with every different kind. But what we've seen before is that they all can go down together, and that doesn't diversify things too well. So now we'll take a look at this chart. And what this is, it's randomly generated. It's randomly done, and we have a bunch of numbers in here and some percentages on the top of the screen that go up by 0.25% each time. And what these percentages indicate is how often one can defeat the spread in a football or a basketball game. And what they do is bet 1% of their starting bankroll of 100 on the game. So their first bet would be $1.10 to win $1 using the Vegas lines of -110. And it goes all the way up to 60%. You really got to go 52.3% to make money in this. And you need good money management skills. There's so much to become a winner. Many people who try to bet sports, and the majority, end up losing. But assume you use the index, meaning I'm going to bet every single play each one of these 60 or 70 people, 80 people that tell me to pick. This person says to pick Philadelphia, I'm putting $1 on Philadelphia. This person tells me to go over in the Portland game, I'm going to go over on that game, and so on and so on. And if that's the case, then your original $1,000 investment after 3 years would be worth about $1,830. Very, very interesting to say the least. We'll go down the bottom of these and show you how each index would have fared. Each one's starting off at 100. And the ones that had the lower percentages, the 40 plus percentages, they're going to lose big. And we can see here that they've lost well over 90% of their value. Most of them. They're all losers. Now we've got a bunch that are only losing 70%, 60%, and 50%. We finally have a winner here. And to show you the volatility of what one stock would look like, what we'll do is we'll take a look at the chart for this one in here. This is a 51.25% trader, meaning 51.25% of the time he's going to get a pick right against the spread. Now what you're going to notice about this chart, which you can see a little bit on the screen, is that it looks a lot like a regular chart, a regular stock. Because what you can see is that you have the a range through time, it sells off, it consolidates, and then goes higher. That could be a normal stock. But by diversifying to all of these different selections, it guarantees that you do well. Now, in reality, you're not going to listen to anyone who's 40% on the long run or 41. You want people who are 53, 54, 55. And if you only went with these, well, then your chart would even be doing much better. However, I'm showing the lower ones for an example purpose. But not only that, but when you determine who the losers are, then it doesn't matter. Why? Because you're betting 1%. This fund at 655 means you're betting 6.5. Here, you're betting 6 cents. Wow. And these numbers you see here, they're the random number generators that I use to determine if a play is a winner or a loser. How this works is this is a random number between 1 and 1,000. And then it takes the random number and it says that if their specific number is below 410 or equal to, it will be a winner. If it's over 410, it will be a loser. Not on a 41% play. On a 59% play, if it is 590 or below, it's a winner. If it is above that, it is a loser. So what we'll do is we'll re-randomize these numbers and show you this chart will be a little bit different but have the exact same pattern. Should be easily over 1500 and it should be easily below 22, but showing the exact same pattern. We'll copy this slide, and what we'll do is we will highlight the all the way down to the bottom and repaste it. We'll get totally different numbers. Just let me finish off this, and you'll notice that the bottom numbers out of 904, 328, 55 will all change. Any numbers you're looking at will change. It's just doing its calculation now. There's a lot of numbers that it needs to change. Many thousands, and you can see that the numbers are now changed. New random numbers. So we'll take a look at what the index looks like. I'll have no idea except for what I said before. Same pattern. And it pretty much looks the exact same. Well, that's because of the way that the math works. But in reality, if you were to be making these wagers on sports and everybody was winning because everybody plays this index like everyone plays the 401ks, well, the casinos would be losing money. And, well, if they're losing money, they got to make adjustments to make sure they win. Maybe they increase the VEG from 10% to 20%, and or stuff like that. And if everyone were to take their money through these types of investments, then well, they would need a bailout because everyone's winning, and well, that would create inflation. You'd have to create all this extra money. So in reality, it's like stocks because well, we know the financial system will make whatever changes they need to make, like banning short selling and issues like that, and of course we've already seen them bail out the banks. So this is just a wacky little example to show mathematics and how the stock market may not be your best investment.